Welcome to the 5th Quarterly Ethics Review, hosted by the Institute for Enterprise Ethics. We have a number of really great topics to review with you, including the FIFA bribery scandal, minimum wage and income and wealth disparities, the Amazon corporation culture as a place to work, the very current Volkswagen emission scandal, the Toshiba accounting issue, and the impact of CEO compared to median employee pay ratios. We also have a great panel to discuss these issues with you. Dennis Whitmer is chair of the Daniels College of Business Department of Management and a professor of management. After receiving his doctorate in public administration from Syracuse University in 1992, he joined the Daniels faculty, was named associate professor in 1998, and department chair in 2007. Philip Schabel is assistant professor in the School of Accountancy at the Daniels College of Business. Philip completed his PhD at the University of Cincinnati and holds an MS degree in accounting also from the University of Cincinnati and an MS in business administration and economics from the Johannes Kepler University in Linz, Austria. Let's get on with the questions. Dennis, the issue of income and wealth disparity has been on the front pages for quite some time. It's been a fact for even longer. Recently, though, we've seen some progress, some would call it progress, some not, changes in minimum wage legislation, and we've even seen some well-known Wall Street capitalists weigh in on this issue in a very positive way about doing something about it. So where are we on this issue, and kind of what direction are we heading, you think?
Well, interesting that you should ask, Dan, because my summer reading consisted of two books, this tome by a French economist, Thomas Piketty, called Capital in the 21st Century, and the other, The Spirit Level, Why Greater Equality Makes Societies Stronger, by two epidemiologists from the UK, and its subtitle is Why Greater Equality Makes Society Stronger, a real key. So the point of Piketty's work, or one of the important takeaways, is that he demonstrates rather thoroughly that inequality globally and in the US has not seen such levels since the end of the 19th century. And while equality increased early in the 20th century, that reversed itself in the 1970s or 80s. And now the top 10% own roughly 70% of capital and receive 45 to 50% of all income. And the top 1%, we've heard about the 1%, own 30 to 40% of capital. He talks about influences on increasing equality or decreasing it, and he argues that increasing educational opportunity and skills are important, and that comes into opposition with the return on capital, which has historically been 4% against an economic growth of 1%. The Spirit Level book is important because they relate inequality to a whole variety of health and well-being measures of individuals and societies. And the general point is that those societies with greater equality tend to have more healthy societies, if you will. So Piketty argues that we ought to have a global tax. And that's interesting, but he considers it utopian himself. If you're asking me, I would go back to his point about education, and I think reducing that gap is one way to deal with this income inequality issue. And the other solution that the authors of The Spirit Level offer is increased employee ownership of business, since business generates the wealth of society.
Philip, what do you think?
Well, let's first remind ourselves that inequality has been decreasing on a worldwide scale. So if you think of the rise of India and China, which lifted lots of people out of poverty, and that's not due to some government intervention, that's due to free enterprise. Then to address some of the points that Piketty or Dennis just made, one is this assumption that that the rate of return on capital exceeds growth, economic growth. That has been challenged by multiple economists, one of which is Matthew Ronley from MIT, a young PhD student there. And what he found is that this assumption or this finding holds mainly true for housing, which is one type of capital, but there's also other things like land, shares, machinery, software, other types of capital. Then Dennis mentioned this diffusion of knowledge and technical skills among as a factor to decrease inequality. That brings up an interesting dimension of inequality, which is within the US across the young and the old. So if you look at the level of wealth among, let's say, people below 30 and then our seniors, then you find a big disparity here. And also, I don't see a lot of investment going on in the educational sector relative to the amount of spending we have on things like Medicare or pensions, right? Then one comment on this idea of having increased employee ownership for companies. As far as I know, there's nothing that prevents employees right now to buy shares in their own companies. The disadvantage of doing this is as employees acquire more and more ownership in their company, their investments become, have a lack of diversification. That means if for some reason the company goes bankrupt, they not only lose their income stream, but they now also have a reduction in their savings, right?
So let me weigh in on this, and my opinion is that this issue of wealth and income disparity in the United States, and from what I understand in the UK as well, particularly, is a huge and growing problem, and maybe the most important problem we face as a nation today. I think the consequences of letting this thing go untreated could be disastrous. We could end up with a totally bifurcated nation, economy, and society. It will undermine our shared culture and our shared prosperity eventually, which could eventually lead to rebellion and revolution, and we've seen it before. The only way we got out of it the last time was through a 10-year depression and a 5-year world war, and we came out of that with great equality. So it bothers me, it worries me. So what do we do? One popular suggestion is raise the minimum wage. That's probably a good idea, but it's insufficient. It just won't have the impact. The second idea is to tax in maybe an extreme way, the very rich. That may be a good idea for other reasons as well, but it too is insufficient and it's politically impossible. We'd never get it done. So the last option, I think, and this rests a bit on Piketty's work, is to move what I would call excess capital out of the financial markets, where it's invested in things that don't create any value except for the person who owns it, synthetic derivatives and things like that, when nobody knows what they do anyway, and move that money into the real economy that produces goods and services and employment. If it stays in the financial market, it just spins in there and doesn't get out into the real economy. If it goes to the real economy, it produces value for consumers, produces values for employees, and produces values to the owners. So if we could move that capital somehow from the financial market to the real market and provide a tax incentive to make the ROI gap less severe, we could do a lot of good in this economy. We just need to incent these investments in corporations to make value for consumers and employees, and to do that in partnership with the school system to train employees for these high-paying jobs. So there's kind of one approach to it that doesn't involve taxation, doesn't involve minimum wage, doesn't involve a political fight, and it employs the real asset we've got, which is capital.
Can I comment on this?
Sure.
So are you suggesting that the government should pick certain industries or certain investments that are preferable over other investments by lowering tax break or imposing higher tax on what you perceive as undesirable investments?
Yeah.
Okay.
I do.
Just wanted to be sure about that,
Yeah.
right?
Yeah,
Exactly.
yeah. Pick the winner.
Exactly.
Right?
Yeah.
Dennis, anything further you want to add?
Well, I'm surprised they haven't invited you to DC lately. You know, you seem to have really a sensible approach to solving this problem. And
You know,
I quite agree about the long-term consequences of not looking at this issue and doing something about it.
You know, it's summer in DC and humidity is terrible, so I decline the invitation. Thank you.
I would like to disagree because I think governments have a very proven track record of being pretty bad at picking winners. So I think the free market is still, I think, the most efficient and probably fairest way how to allocate capital for investments, right? So where the higher return is, that's where it goes. And I think to another comment for Piketty's argument that as the capital stock increases, the return on this capital probably decline, right? So that's fairly common in economics. You find a diminishing rate of return as you increase your stock of wealth.
Well, the fact of the matter is, returns to in the financial sector are higher than the returns in the economic sector, and will probably continue to be. Right. And if it stays that way, we're in for some dire consequences because we'll never get all that excess capital back into the real economy. And somebody's got to make the choice. Somebody's got to make the decision. I will volunteer, or the federal government.
I found it interesting that you very quickly said that the financial markets were efficient and fair.
No. The free market.
The free
not
market.
Yeah.
Is efficient and fair.
Yes.
You know, those are really two separate questions.
Yeah.
So I would agree with you about the efficiency, but I'm not sure about the fairness, which is precisely why this is such an important issue.
Yeah.
In the free market, you have two parties having a voluntary transaction, right? Which means they're both at least equally or better off than before. So I think that's a fair deal.
And if one happens to have a tax incentive and the other one doesn't, that's okay with me.
Yeah, but the tax incentive comes from somewhere, right? It comes at the expense of someone else.
That's right.
Yeah,
That's
but you
right.
make a very important assumption there, right? That's a voluntary, truly voluntary exchange, right?
Yes.
That isn't always the case, especially when it comes to labor, in labor markets, for example.
Yeah. Well, we'll have some next topic we'll actually discuss.
Gentlemen, I think we've done our duty on this one.
Okay.
Let's move on. Thanks, guys.
So, Philip, I assume you saw the New York Times expose about Amazon. It highlights what appears to be a brutal, if not inhumane, culture. In one instance, after surgery, the employee's manager said, and I quote, "I'm sorry, the work has still got to be done. From where you are in life, trying to start a family, I don't know if this is the right place for you." So, what do you think about what seems to be going on at Amazon? What are your thoughts? And is this a sustainable culture in business?
Okay, thanks, Dennis. So I think when you look at Amazon and look at their recruiting website, right, and the material, they don't make a secret that this is a culture that prizes customer obsession. It's one of the first leadership principle they have. And obsession is a pretty strong word, right? So if you talk about obsession about the customer, they expect very high effort, high commitment, 80-hour work weeks, as it was described in the article. And I think. Also, when you look at the statements from the HR people, so I quote Susan Harker, she's one of the top recruiters at Amazon. She said that this is a company that strives to do really big, innovative, groundbreaking things, and those things aren't easy. So I think it's any employee who wants to work for Amazon should expect a certain level. So when you read through the article and the other articles, employees speak of the punishing work culture, the lack of a work-life balance, but they also speak about the thrilling power to create. Some speak they get addicted to this feeling or to the atmosphere at Amazon. So here, for instance, one employee said, working at Amazon is like a drug that one could get self-worth from. I think all this together shows that despite the bruising work culture or the high level of commitment requested by the employees, shows that Amazon seems to give its employees something they desire a lot more than a cushy work environment with 40-hour weeks and plenty of time for vacation. The fact that Amazon has a fairly high turnover, I think, is consistent with this type of high-powered work culture. Okay. Then this bad example you mentioned with the manager, where or an employee was penalized for having surgery. I think when you have a company with 180,000 employees and you dig long enough, you'll find one or the other the bad apple in there among the managers. And to summarize, I think it's all the people, most of the people who work for Amazon are in a situation where they are voluntarily, they can choose. They all have plenty of opportunities. It was also mentioned in the New York Times expose that those that left felt they benefited, or their career benefited extremely from having worked for Amazon and having that on their resume.
Do you have thoughts on this, Dan?
You know, I do. First, I think it's a shame that there are people running companies, starting companies, who think that in order to build a great business, they have to have such a demanding and maybe oppressive culture. And I've seen that a lot of times. And in my view, it's just a shame that people can't be sufficiently creative to build a great company on the foundation of a great culture. Now, on the other hand, Jeff Bezos may think this culture is a great culture, and there he and I just have a value difference. I fully understand that for some young people, they may view this simply as the price for a really meaningful career, and they're willing to pay that price voluntarily. Well, I feel sorry for them because I think they're missing out on a great deal of the rest of their life. But as you said, it's their choice. I also understand that working at a place like Amazon can be the source of marvelous experience. When I was coming up, Procter & Gamble and IBM were places like that. Marvelous experience. You spend a few years, you learn those kind of secrets, and you go off elsewhere. And my hope is that when they go off to elsewhere, they shed some of that skin, that culture skin that they picked up at Amazon. I also understand that there is a segment of people who really thrive on a culture of power, of politics, of competition, of abuse. Then they love it. And so for them, this is like nirvana. Greatest place they'd ever worked. Well, good, because that Amazon keeps them from kind of getting in the way of other good businesses, of making them toxic. So, we've still got some time to go before we see whether this is a sustainable practice. Time will tell. I know that Jack Welch, even before he left GE, came to the realization that he should stop the performance reviews that were kind of calling the herd, which Amazon is one of the few companies still doing. So we shall see.
So Dan, the FIFA story has been coming up again in the news lately, and since Sepp Blatter has been indicted for corruption. So what do you think about this whole situation?
Well, let me quote a good friend of mine, Bill George, who's professor at Harvard in the leadership program there, former CEO of Medtronic and other places, on his blog. Quote, "Soccer's FIFA is a morally corrupt organization," end quote. And we all know there's been suspicions and rumors about FIFA and all the money that floats around the soccer business around the world for years. Well, we finally got some real facts, at least alleged facts, put it this way. And that is, at current count, about $150 million of bribes and kickbacks and other under-the-table payments involving at least 14 FIFA executives, very senior FIFA executives, going on over a 24-year period. So this isn't just a kind of a splash in the bucket. Last May 27th, Swiss officials, in a pre-dawn raid of a 5-star Zurich hotel, arrested these 14 executives. They were there for a FIFA meeting. Sepp Blatter, the president of FIFA, said, quote, "I cannot monitor everyone," end quote, so it wasn't my fault. He was re-elected for another 5-year term the next day. Later, in fact, just recently, he was indicted in Switzerland for, quote, "payments unfavorable to FIFA." That's got to be a very European way of saying what really happened. And also for, quote, "disloyal payments" to another FIFA executive. So, clearly there's money floating around this organization with no accountability whatsoever. My question is, how in the world does this happen for a very, very well-known and very, very powerful organization, even though it is a non-profit, apparently charitable organization? I think I know where the charity goes. It's a well-known organization. It involves lots of people. There are big dollars involved from big companies and big cities, and it's gone on so long. How can this happen? Well, I think there are 4 kind of enabling factors to this. One is it exists in a favorable social economic culture where business is done to a very large degree by doing favors for friends. And these 14 people and others were really good friends and had been good friends for a long, long time. Secondly, it's a private, quote, nonprofit organization with no independent governance. There's no board that oversees this that's independent. Third enabling factor, long terms of service. This is the original good old boys. Tight group, mutual secrecy, doing favors for each other all the time. Favors for friends. And fourth, it's involved in a market, the global, the international soccer business that accounts for that has huge unaccounted for cash flows throughout the industry. So, what can be done about this? I mean, there's people going to jail and there's going to be long investigations, but I think there's 2 things. One, these sponsors, and they include the biggest sports manufacturers, equipment manufacturers, apparel manufacturers, the largest cities in the world competing for these cups, huge broadcasting companies, they've got to just withhold their sponsorship until they're satisfied that FIFA has been totally restructured. Secondly, they've got to drive a program that will create an independent board of governance and accountability for FIFA, and that has to be demanded by the sponsors before they reinstitute their sponsorships. So that's what I think about it, Philip.
I have one thing to add here, Dan, and one is when you think of FIFA as a charitable organization, as a club basically, incorporated in Switzerland, there are no owners, right? So in these organizations. And just to give you an idea of how profitable FIFA is, they had a revenue of 5.7 billion in 2014, and that led to a net result of $338 million in the same year. Now the question is, where does this go, right, when you have no owners? An also interesting fact is that FIFA consists of 209 national associations, soccer associations, and they have the voting mechanism there works one nation, one vote, right? But that's limited to the soccer associations. There's no vote for representatives from sponsors, players, hosting countries, or other stakeholders involved. So I think if that would be one way how to address this issue, right? Especially from the side of the sponsors, to argue for we want to be able to vote on these decisions as well. For instance, where the next World Cup or World Championships are held.
What do you think, Dennis?
Well, actually, I agree very much about both of your points regarding sponsorships and the accountability mechanisms and the governance issues. As I heard you both talking, it seemed to me that this reflects a deeper global issue, and that's one around bribery. And it goes all the way back to the early 1970s, and when the U.S. at least implemented the FCPA, the Foreign Corrupt Practices Act. We were very much a leader And if there's anything optimistic about what's happened here, is that since then, most of the rest of the world has moved at least to embrace the insanity, if you will, of bribery and corruption. It just hasn't gotten to FIFA yet, unfortunately. But I do think it is a global culture of corruption and bribery that undergirds FIFA, so they are certainly not alone. And one small instance, I teach Mexican students every 2 years in a master's program, and I use a bribery case. The last time I did it, and now Mexico, by the way, has a law comparable to the FCPA. And I asked the students to decide in a scenario whether they would give a bribe or not, both in terms of whether there was a law that prohibited it and when there wasn't a law. In both cases, it was unanimous. They all said they would pay the bribe. So I'm afraid the culture of the globe hasn't caught up with us yet.
You know, it's one thing to have a law, it's a whole other thing to enforce it.
Yes, indeed.
All right, thanks, guys. All right, guys, now we're going to go into the quick hit session. We've got 3 topics we each have our own personal points of view about. So we each get one shot at our point of view on the issue. All right? I'll start this with the accounting scandal at Toshiba. Now, this may not be on the top of everybody's mind, especially in the United States, because it occurred all the way over in Japan. But I thought that we were done with blatant book cooking, but I guess not. Enron and WorldCom and HealthSouth and all those people we're familiar with from 10, 15 years ago, they look like amateurs in front of Toshiba's activity. In Toshiba, the rank and file apparently got quarterly challenges from their senior execs, always toward the end of a quarter, indicating how much money they had to find to make that quarter's numbers. And in this organization, like many in Japan, there was a culture of obedience to your superiors. So they did what they were told. Artificial accounting adjustments totaling $1.2 billion over 7 years and across the reign of 3 different CEOs. I first have to ask, where were the auditors on this thing? In fact, I can't even find who were. I didn't look all that hard, but it wasn't in the articles who the auditors were. To me, it's just another example of kind of a malignant culture.
Yeah, to add to this, I had the same question, where were the auditors? But one interesting thing I read in the articles was the reputation of Toshiba within Japan was spotless up to this point. And many pension plans heavily invested in Toshiba. So I think one thing that we saw going on here was these managers had this tension between reporting accurate numbers and letting down a lot of the investors and fellow countrymen, right? And we know in Japan the culture and loyalty is a very high value in the Japanese culture. One thing I would be interested in seeing going forward is who is held accountable for this, because penalizing the company doesn't really penalize the people who perpetrated this crime, right? It really hurts the investors, right? Current investors and future investors, and not really the managers and executives who conducted this crime.
I found it interesting that it seems so intentional for such a long period of time. And true to the culture of Japan, the CEO and the two top executives resigned, as I recall. So, they very much accept the responsibility. And yet this was going on in the organization. They also say that they never encouraged employees to falsify the books, and they did not directly tell subordinates to falsify the books. So this reminds me of some research that's been done in management, especially with mid-level managers. And when wrongdoing occurs, most often the leaders of the organization are not directly in telling employees to falsify, but rather they're saying things like, just get the job done, which I think in the pressure that you talked about earlier is consistent with that.
On August 5th, the Securities and Exchange Commission adopted a final rule that requires publicly traded companies in the US to disclose the CEO pay to the median employee pay ratio. This is part of the Dodd-Frank Act, which was passed in 2010 to overhaul financial regulation. And these companies will be required to disclose this ratio starting with fiscal years beginning on or after January 1st, 2017. Now, to give viewers some perspective about what this ratio has been doing in the past, around 1980, the average ratio for companies was 30, and now in 2013, the average ratio has increased to 300. So clearly that suggests that the increase in CEO pay has been exponentially higher than the increase in pay for the median employee. Now let's keep in mind that the stewardship and the competent management of large, complex corporations is a very important task, and I think should be entrusted to the most capable people with the proper skill set, and that deserves high compensation. Now, just to put things in perspective, the CEO of Walmart, he runs a company with 2.2 million employees, and Walmart had $1 trillion in revenue last year. He made around $90 million in compensation. Now, there's plenty of Major League Baseball players, NFL players, NBA players, and several actors who make far more than him. You can argue about the societal value of each task. Then possible explanations for this diverging trend in compensation. One is a winner-takes-it-all situation where the most capable, most skilled in a certain group get compensated exponentially more than the second or third tier. And so if that's what we find, then I think this very high CEO compensation is rational, efficient, and I would also agree fair. Again, to go back to this Walmart example, if each one of these 2.2 million employees, who's probably very interested in having a competent CEO for their company, pays $10 a year, then we would have $22 million in compensation for the CEO. Well, right now he gets 19. Then another compensation could be self-dealing. So among corporate boards, so that would be at the expense of investors. That would be unfair, inefficient, and also wrong, right? So if we have a situation, if this is the explanation, then I think this pay ratio should shed more light on this topic, and probably also shame companies into adjusting the CEO compensation. Now, a couple of unintended consequences we can expect. One thing is that managers will try to manipulate this metric simply by laying off the lowest compensated employees, right, and replacing them with contractors. They would change the calculation, simply increase the ratio. Another thing we have to keep in mind is that this ratio is very difficult to compare across industries. Just think of banks as opposed to fast food companies, right? So McDonald's will probably have a very high ratio in that regard versus, let's say Goldman Sachs, for instance, would have a lower ratio.
Well, I certainly applaud the SEC's rule because markets depend on accurate information. And for investors or customers, it's relevant information. So I applaud that, even though it was resisted by associations and industry groups. It also makes me think back to Piketty again. If you read his analysis, he argues that the increase since the 1970s or 80s in inequity globally is directly related to what he calls the rise of the super managers, precisely the group we're talking about. And if they were paid at that time 30 to 1, and they're now, and it's fair and efficient that they're receiving 450 or 350, whatever the number is, they must have been horribly underpaid then. So I have my doubts and suspicions about that. And so I would just add a couple of things that I saw recently, a chart with other countries and how the U.S. compares. And it ranged roughly from about 8 to 40 as the ratio compared to where we are. In addition, a sample of customers and citizens were asked what would be a fair ratio. And the average they came up with was 30. So a far cry and very much back to where we were 50 years ago.
Well, Dennis, first, the compensation committee of a large corporation is not a democracy, so yeah, the public doesn't get to vote. I think, stated simply, that the whole idea of this ratio is silly. Now, I will also agree that CEO compensation levels have become obscenely high. No doubt about that. And I think one of the major reasons for this is that some years ago, the composition of the CEO's compensation was much more heavily weighted to equity grants, options, shares, and so on. And that was at the front end of a very rapid rise in the equity markets. So it's no surprise to me that you give them more equity and the equity grows more rapidly, the ratio is going to get out of whack. Serious investors don't care about that ratio. It's not going to inform their investment decisions a whit. Other investors may, but the serious investors, which probably accounts for 99% of all the capital going into those markets, they don't care. This ratio provides absolutely no meaningful economic information to the corporation. Doesn't help them run the business one bit better. My view is the sole reason for doing this, because it was, and this is why it was pushed so hard by the unions, the labor unions, is simply to embarrass some and to mollify others. And that's it. I think it's a waste of time also because the data's been out there for years. The labor unions have been collecting this data and reporting it, especially on the companies that they're going to go into bargaining with for decades. Finally, there are much better other ratios to calculate to evaluate the appropriateness of a CEO's compensation, like compensation relative to the number of employees that he's responsible for, the dollars worth of assets that he's responsible for, the number of capital facilities around the world that he's responsible for, the number and the value of the shareholders that he's responsible for. That's what he gets paid for. He doesn't get paid for determining the assembly line workers' hourly pay. So we've all been watching and reading about the adventures of the Volkswagen Group in Wolfsburg, Germany, and their valiant attempts to get their new clean diesel consistently under the U.S. EPA standards, and for quite a few years successfully. When they were discovered that they put some software into these cars that would basically invalidate the testing procedures, we were all shocked, including Mr. Winterkorn, the then CEO of the Volkswagen Group, who said, quote, "I am stunned that misconduct on such a scale was possible in the VW Group. It reminded me of the Peter Lorre character in Casablanca. Gambling in my shop? I'm shocked, shocked." He also said, quote, "I am not aware of any wrongdoing on my part." These are direct quotes. The executive committee of the Board of Supervisors said, quote, speaking of Mr. Winterkorn, "The CEO had no knowledge of the manipulation of the emission data." So, I ask sort of once again, how does something like this happen? And there are, in my view, about 5 kind of enabling conditions. One is a very autocratic leadership culture in that organization, and it's been that way, since the first Volkswagen was produced under the Nazis. Secondly, there's a very, very, very dominant engineering culture there. So problems are to be solved, and it doesn't matter. There's no moral judgment on the solution. Third, very tight voting control by 2 families. 2 families control the voting shares. They've got split shares, their shares and B shares. Fourth, no independent directors on the Board of Supervisors. None. They're either corporate executives or union leaders or management representatives. Charles Ellison, the governance guru at the University of Delaware, said, quote, "The governance of Volkswagen was a breeding ground for scandal. It was simply a matter of time." Then, on the other hand, Winterkorn and the executive committee may be right. It may have been a situation where they were bound and determined to become the largest auto manufacturer in the world, not unlike Toyota some years ago. And in order to achieve that position, they had to vastly increase their market share in the United States, and they decided that the clean diesel strategy was the way to do that. And so I can just see Mr. Winterkorn telling the people producing that car, do whatever you have to do, whatever it takes. We need to win the U.S. market. Do whatever it takes. I don't need to know what it is. So this is a similar situation as I saw in the Walmart issue when it first came out that the Walmart representatives in Mexico were bribing Mexican officials in order to get permission to build stores. And I can just envision the strategy meeting of the board of directors when the strategy was presented to get, in response to their request for a 20% increase in our business in Mexico. Anybody who's not brain dead knows there's only one way to do that. But nobody told anybody to go bribe the officials. So, and I think it's the same thing as in the Toshiba situation. Challenge, make the quarterly numbers out of, do what you need to do. So I think it's another case of this kind of malignant autocratic culture having sway over everything else.
I have a quick comment on this VW debacle. I think there's one very positive thing here, which is that it highlights how difficult it is to build cars or diesel cars that are fuel efficient and fun to drive and meet the emission thresholds. So I think what this will do, it will provide a huge boost to the electric car industry and alternative cars.
Well, I must say that being someone from the 1960s, I can remember kind of the original Beatles hitting the U.S. And while we weren't very environmentally conscious, it was an institution at the time. And so I was extremely stunned, as was the CEO, by what happened here. And I guess for me, it does reflect a culture that I don't have the information yet as to understand exactly how that decision-making occurred. I totally agree that it looks like an autocratic culture where the message was, whatever it takes, get it done. But I'm still very curious, since this was so intentional. It's unlike the Pinto case back in Ford when they identified a flaw and how they were going to address that. This was designed. It was the designed misleading information for the consumer. So I guess that's my comment.
Well, I think over the next couple of months and years, we'll find out exactly what happened, and we'll see what the Volkswagen Group can do about it.